Hello, guys. Good afternoon. Today is the 17th of February, the year 2024, and my time says 3 o'clock. All right. Our latest video today, we will discuss property development and funding. So, we're going to delve into what a would-be property developer would be considering or looking at as they're looking to secure financing and funding for their project. It's quite the expansive subject. We will not be able to cover all of it, but I do hope that we can touch on some of the more important things to understand or think about as one embarks on a property development project. Part of the inspiration for making this channel was to help, just share knowledge, share information on the property development or the property business, as well as to learn, from the experiences of others, and sort of like develop my own skill set and understanding. For those that might be new to this channel, I'm a Zambian citizen resident in Zambia. I have been working in the real estate industry the last 4.5 years, in which time I have worked as a property broker and now hoping to transition into property development as well. I have studied property development and investment. I have studied property management, contracts and administration. I have also studied construction management with the University of Cape Town. Okay, so now let's dig into it. If you are a property developer or a would-be property developer, you would sooner or later have to come heads on with that thorny issue of raising money for your project. And so you would have to understand the raising of capital for property development, how it works, and what you want to know as you go about raising finance. Okay, so basically we want to begin by understanding what it entails to finance a property development project. Goes without saying that property development is capital intensive, especially for large scale projects. For those of you viewers that might not be intimate with this channel, many of the examples I use here are relevant to the Zambian property development industry or the Zambian real estate industry, but of course, there would be overlaps in some of the material. So very briefly, I'm going to quickly go over funding and financing. Okay, just an understanding of funding and financing. Okay, now, loosely defined, finance is the management of large amounts of money, especially by banks or large companies. Okay, that's the loose definition of finance. However, in property, it refers strictly to lending from a traditional bank. Okay, lending rather, or borrowing from a traditional bank. That is finance. So strictly in the property sense, finance is when you as a would-be developer approaches a bank or traditional financing institution, which is of course a bank, and borrow money from them. That is finance. Funding, on the other hand, refers to capital provided by an organization or government for a particular purpose. So funding is capital provided by an organization or government for a particular purpose. I beg your pardon, I had some objects just fall over there. Okay. In property, of course, it refers to lending from a non-banking organization. So finance is lending from a traditional lending institution, i.e. a bank. That is finance. Funding is lending from a non-banking organization. And there's several such organizations that would provide you that type of finance, as we'll see in the progress of this video. Okay, now I'm a property developer. Let's imagine looking for financing. What are some of the things I would do well to consider when looking for capital for my development? Let's just quickly go through those. So number one, I would want to think about the size of my project, because then that informs me of the capital requirement for the project. Typically, large-scale projects, for instance, a shopping mall such as, say, East Park Mall in Lusaka. And I'm only sharing this information because it's in the public domain. East Park Mall was developed for a figure in the region of $200 million. And that's me being conservative. It should have been more. I think it was around $250 million. Okay, so that is a large project. Therefore, will require huge capital outlay. So number one, property developer or would-be property developer would be thinking about the size of their project as they go about the capital raising task. Okay. The second one would be the cash flow requirements of the project. Okay, slight difference between capital and the cash flow. So I would have to think about the cash flow requirements of the project. How much money will the project need at every particular stage from initiation to completion? Okay, how much money would I need at every different stage of the property development process? Okay. And the third one would be the project's timing. The third one would be the project's timing. Okay. What is the duration of the project? How long would it take from start to finish to get this project done? And this is important because it speaks to loan tenure. If I'm going to obtain a loan from the bank, it also speaks to the interest rates, and several other terms with regards to the facility I obtain from the bank. So number one would be the size of project. Number two would be the cash flow requirements. Number three would be the project's timing. Okay. The fourth, not necessarily the final one, but the fourth one would be who the investor or developer on the project would be. Is this a team of investors? Am I doing this on my own? Is it sort of like a consortium of developers and so on? This is important because it also helps when the bank is doing its due diligence to lend you the money for the project. Okay, so very quickly there, just, a brief understanding of the subtle difference between finance and funding in real estate. The second issue I wanted to touch on was what banks and lending institutions look for in would-be clients looking to borrow money for property development. Okay, number one would be so-called the borrower risk. So they carefully assess your character as the borrower. They want to know if you're a stand-up client. They want to know your risk profile. They want to know that their funds are safe with you and that they will be repaid as and when you agree with them. Okay. They also want to see your ability to see out an investment in the long term. Development projects are not short-term projects, nor are the repayment terms. It's usually over a medium to long-term horizon. So whereas it would typically take you, let's say for a house, if you have all of the money up front, it would typically take you maybe a month to develop it, and not so long a time if you're a commercial developer not so long a period, rather, not a time. It's not so long a period. If you're a commercial developer to pay back the money, it's not the same for large-scale property development undertakings. So, for example, developing a city, developing a town or a township, developing a shopping center, and so on. These usually require huge amounts of capital outlays, therefore also speaking to a much longer, loan tenure on them. So they want to assess the investors, the investors' ability to see out the project in the long term. Okay. The third one would be your ability to bring equity into the deal. Because if you're going to ask for a huge amount of money, there's a good chance the bank will not give you all of it. Okay? So they want to see that you're putting up some of your own money, because then that tells them you have a lot of skin in the game and you have a lot to lose should it go south. But also, what is your ability to bring in other investment from elsewhere into the deal to make it work? Okay? So they will assess your ability to bring some other equity into the deal. Okay. The other one is the asset they are lending the money against. They want to have a look at the asset or the development they are lending the money against, for very straightforward reasons. Again, they are hedging their bets, or rather they are mitigating their risk. Okay. So a couple of things they'll consider. What is the value of the asset? What is the value of the asset? The value of the asset tells them sort of what amount of money would be appropriate to lend against it. Okay, so number one, they'll look at the value of the asset. They'll also look at the revenue that said asset can generate in the market, realistically speaking. So they'll consider the amount of revenue that this asset can generate in the market, realistically speaking. And I use the term realistically speaking there because, they consider several things. They'll consider market dynamics at that particular time. They would consider the state of the asset, what sort of rent it would, if it's, something that you want to lease out, what sort of rent it would be able to attract, what sort of tenant profile it would attract, and therefore, how much revenue it can generate. Of course, this is important because then it tells them how much, speaks to your, the borrower's ability to pay back the money they borrow from the bank. Okay. Furthermore, they'll look at the loan to value ratio. Of course, loan to value ratio. Occupancy rates is another thing. They want to see that the asset has a very high occupancy rate, because then, it means that your risk profile is kind of like, it's healthier. So if you have a commercial development, for example, or you're looking to develop a commercial development, they would need a demonstration of, you know, what sort of occupancy you'll be looking at having on say development, therefore what revenue it would generate. Okay, other things, of course, stuff like the asset class and so on and so forth as well. Is it a commercial asset? Is it an industrial asset? Is it a commercial development? It needn't necessarily be one asset. It could be several assets, in a commercial, in the commercial asset class, and so on and so forth. Okay. The other thing they will look at are the economic indicators. What are interest rates at that particular time? If they're lending out their money, they want to think about what the interest rates are, because then they also, want to consider, the borrower's ability to sustain that loan under that, interest rate, amongst other things. They will look at your property management ability. Property management ability, because of course they want to see that you are able to sustain the investment, as an investor or developer long enough for them to recoup their money. Okay? Can you secure lease agreements? When you develop the property, would you be able to get tenants on and occupy the building and generate income for your repayment? Okay. Do you have approvals from your local authority? Has the building been cleared, or would it be able to get the approvals from the local authorities for occupancy? Would you have an occupancy certificate? Do you have all the other relevant approvals for occupation of said development? Okay. Moving on from that, what are some of the other main considerations by lenders? Number one, they will do a feasibility study of the project. Okay, we briefly went through this before. They will do sort of like revenue analysis of the asset or the development, try and see how much money it could or is generating in the case of a development that's already running, that you're looking to extend or improve, what have you. Okay. So they'll also look at your operating costs to see how much money is being taken away from the revenue the asset is generating you. And of course, they'll look at the competencies of the management team. Okay. Having said that, we move on to traditional and non-traditional funding models for property development. Remember, in the beginning, we briefly defined what finance and funding is, and we also got an understanding of the subtle difference between the two. Now, in this particular part of the chart, we will look at the two main, funding, or rather financing models, traditional and non-traditional financing models, and what those mean for you as a would-be property developer or as a property developer in the market. Okay, so the traditional funding model is basically where you borrow from a lending institution, typically a large bank. That is a traditional funding model. What would they be asking for, if you're looking to take that route to raise money for your development? Okay, what is the process that would be involved in raising money from a traditional financing organization such as a bank? Okay, so basically you meet with the bank. The bank gathers its data. They do evaluation or ask you for evaluation, and then do a feasibility of the project in question. And then you put in your credit application, and then you sign a formal contract, and then they submit the legal documentation, usually to your attorneys, and then they do the disbursement of the funds. Okay, just important to mention here that there are different types of loans that you could access as a property developer under this model. These are, namely, development loan, construction loan, and the term loan. We're not about to get into each one of those for this particular video. Just a brief mention of that. Okay, for the non-traditional property finance, here you're borrowing from typically would be non-lending institutions, as businesses. So basically, you're not borrowing from the bank. You could borrow from other lending institutions, and these would be anything from private investors, venture capitalists, for instance, organizations such as the International Finance Corporation are known to do this sort of thing. You have had money lenders and so on and so forth. So those would be private investors that you'd look to in the non-traditional financing model. You could also look at this thing called syndicate funding. Okay, syndicate funding. So basically, a group of investors come together, they pool their resources, and they invest in a property development project. This is very popular amongst startup entrepreneurs. So that would be syndicate funding. Of course, this would involve passive and active investors at once. Okay, so that ends our discussion for today. Just a brief delve into the property development process, as well as raising capital for such projects. We would in future chats delve much deeper into what all of this entails even further. We look at some of the risk involved, as well as the upside to it, and so on and so forth. But for today, this is where we conclude. Thank you for joining us once again. Hope you have a lovely day ahead. Remember to subscribe and share the content, of course. Till next time, keep it locked. Bye.